but I'll just touch on it a little bit more here. It says it captures the reasoning for initiating a project or task. And the logic is that any initiative that would involve money or effort, then there should be a specific business need for that initiative. And that is what is captured in the business case. So the business case provides that justification for undertaking the project. And then in a business case, you should have your statement of need, recommended solution, the timeline, the risk, the opportunities, the estimated cost and time frames. And this is exactly what it looks like, the key elements of a business case. We see reasons, options, benefit, cost, timescales, risk. But here is where I want you to look at. You need to know the business needs and outcomes, the preliminary options, that needs to be included, the viable options, you do a cost-benefit analysis, then the justification for the option that is preferred, the cost, the risk, the implementation plan, then management and capacity. All right, so this is a balance sheet, and a balance sheet is basically giving you the statement of the business's assets, liabilities, and equity at a specific point in time. And you see that it gives you December 31 right here. And so assets would always equal liabilities plus equity. And as you can see, this is assets. It equals 47200 right here. Now for liabilities and equity, when you add those two up, then you get the same 47200 right here. So the balance sheet is going to show you the snapshot of the business as reported on a single day. Now the income statement would show you rather the revenue. It will show you the revenue, the expense of that organization. The revenue, the expense. You can see here that we can see the sales that this organization made. We can see the expenses and we can see the income. So revenue minus expenses is the net income, and it shows you the bottom line of how that organization is performing. It's also called the profit and loss statement. Now, this just shows you the difference between the balance sheet and the income statement. So for balance sheets, we have assets is equal to liabilities plus shareholders' equity. In income statement, revenue minus expenses is net income. And balance sheet will show you a single point in time. Income statement will show you a period of time. In income statement, you have reports company performance, but the balance sheet will report the company financial position. It tells you how can the business improve performance, but the balance sheet will tell you how can the business meet its current financial obligations. The components are revenue and expenses for income statement. For balance sheet, it's asset, liabilities, and equity. The reporting time frame for income statement is a specific period, but the balance sheet is for this current time. Now, this is what a cash flow looks like. It basically tells you the amount of cash that is entering the organization or leaving the organization. And a negative cash flow would indicate that probably sales are low and the cost of production is very high. And that's in operations, but a negative cash flow in financing could show that organization is relying too heavily on loans. Because in financing, if it is a negative cash flow, then it probably has a lot of loans that it's relying on. For accounting terms and explanations, we're going to start with accrued expense. All right, so with accrued expense, what it means is expenses that have been incurred but not yet paid. Accounts payable is money owed by the business to its suppliers. So it's to pay that money, accounts payable. Now, accounts receivable is money owed to the business by customers, money that the organization expects to receive by customers rather. Assets could be tangible or intangible items of value owned by the business. Audited financial statements. So these are financial statements that have been examined by an independent auditor to ensure their accuracy and that it accurately represents the financial condition of the business. Balance sheet is, like we talked about already, assets is equals to liability plus equity. Cost of goods sold, money spent on supplies and labor to produce goods and services. Equity is the value of the business to the owners after all liabilities have been paid. Now, expense is money spent to operate the business. GAAP, generally accepted accounting principles. This represents standards established by the Financial Accounting Standards Board for recording financial transactions. Gross profit, net profit. So sales revenue minus the cost of goods sold is the gross profit. Net profit is gross profit less operating expenses. Liability is money owed by the business to others. Retained earnings, net profits that are not distributed to owners but remain in the business as equity. Revenue, money received from customers for products or services.